Most people think markets react to bad news. They don't. Not really. What markets react to is the moment when something shifts quietly beneath the surface. And most people haven't noticed yet. If you've watched financial headlines for long enough, you start to see the pattern. The story always comes after the move. The explanation arrives when the price has already changed. And by then, the important part, the shift in expectations, has already happened. That's what makes days like today confusing for many investors. Prices fall suddenly. Metals move fast. Charts look dramatic. And the immediate reaction is to assume something fundamental must have broken. But markets rarely move because of a single headline. They move because a chain of small pressures finally lines up in the same direction. Currency strength, liquidity tightening, portfolio rebalancing, institutional positioning. None of these things make dramatic headlines on their own, but together they can move billions of dollars within minutes. So before we jump to conclusions about what today's price action means, it's worth slowing down, looking carefully at what actually changed, separating what we know from what people are assuming, because the difference between those two things is where most investment mistakes begin. And that's where we'll start. During the latest trading session, both gold and silver experienced a sharp and rapid decline over a short period of time. According to market data reported during the session, the move occurred within roughly an 80-minute window. During that period, gold fell by approximately 2%, while silver declined by more than 5%. Estimates circulating in market summaries suggested that close to $1 trillion in market value across precious metals-related assets was erased during that interval. At the same time, the US dollar index, DXY, moved higher. Intraday data showed the index rising close to 1% during the same time frame. Currency movements of that size can affect commodities priced in dollars, including precious metals. Looking at the broader price context, silver had been trading near $31 per ounce roughly 1 year earlier. Recent price movements earlier this year pushed the metal substantially higher before the latest volatility occurred. Recent trading activity has also been characterized by unusually wide intraday ranges. Market observers tracking daily price behavior noted that during the past several weeks, silver has experienced multiple trading sessions with $10 or more intraday price movement per ounce. Some sessions saw ranges between $15 and $20, and at least one session saw a significantly larger price range. In the futures market, pricing differences between spot silver and futures contracts were also observed. At certain moments, spot prices briefly traded above nearby futures contracts. In commodity markets, this condition is referred to as backwardation, meaning the current delivery price exceeds the price for future delivery. Separately, market participants monitoring global exchanges noted that the Shanghai Gold Exchange weekly report published inventory data for gold, but did not display the usual silver inventory figures for the reporting week covering February 24th through February 27th. These developments occurred alongside broader volatility in global financial markets. Overnight trading data showed declines in several Asian equity indices, including the Nikkei index in Japan, which fell by roughly 5%, and the Kospi index in South Korea, which recorded a larger single-day decline. Those are the observable facts surrounding the most recent market movement. Price movements in commodities rarely exist in isolation. When a sharp move occurs in a market like silver or gold, it usually reflects a sequence of interacting forces rather than a single trigger. The first link in that chain during this episode appears to be the movement in the US dollar index, DXY. Precious metals are globally priced in US dollars. When the dollar strengthens quickly, the purchasing power of foreign buyers effectively declines. As a result, demand can temporarily weaken, which often places downward pressure on dollar-denominated commodities such as gold and silver. This relationship does not operate perfectly every day, but historically it has been a consistent short-term influence. A second factor relates to liquidity and portfolio positioning. Large institutional investors frequently hold diversified portfolios containing equities, bonds, currencies, and commodities. When volatility rises across multiple markets at once, these institutions may reduce exposure or rebalance positions. In practice, that can mean selling assets that have recently appreciated or reducing positions across several markets simultaneously. That type of behavior is sometimes described as a sell everything moment, where liquidity becomes more important than maintaining exposure to a specific asset class. A third dynamic involves the structure of futures markets. Precious metals trading often occurs through futures contracts that represent commitments to buy or sell metal at a future date. When the spot price moves above the futures price, a condition known as backwardation, it can indicate stronger demand for immediate delivery relative to future delivery. This does not automatically signal a shortage of supply, but it can reflect short-term imbalances in market positioning. Another factor worth noting is the increasing institutionalization of commodity markets. Over the past 2 decades, metals have become integrated into broader financial portfolios through exchange-traded funds, derivatives, and algorithmic trading strategies. This integration allows capital to move in and out of the sector more rapidly than in earlier decades, which can amplify short-term price swings. Finally, broader macroeconomic conditions also influence precious metals. Currency movements, interest rate expectations, and global economic uncertainty all affect investor behavior. Metals often serve both as industrial commodities and as financial assets, meaning they can react simultaneously to changes in manufacturing demand, currency dynamics, and investment flows. Taken together, these forces help explain why the price of silver or gold can change quickly even when no single headline appears to justify the magnitude of the move. Market structure, liquidity conditions, and currency movements frequently interact in ways that produce rapid adjustments in price. Understanding that chain of cause and effect is essential. Without it, short-term volatility can appear random. With it, the movement becomes easier to interpret within the broader financial system. Sharp moves in precious metals are not unusual when viewed through a longer historical lens. Rose from below $5 per ounce to above $50. Over the same period, silver rose from below $5 per ounce to above $50, representing one of the most significant multi-year advances in the metal's modern trading history. What is important about that period is not simply the final outcome, but the path it took to get there. The upward move was not smooth. Silver experienced repeated corrections, periods of sharp volatility, and sudden price swings throughout the cycle. Several declines of more than 20% occurred during that decade, even while the broader trend remained upward. This pattern is common in commodity markets. Because commodities are influenced by both financial flows and real-world supply and demand, prices tend to adjust in bursts rather than through gradual movements. Another historical reference point is the behavior of precious metals during periods of macroeconomic uncertainty. For example, during the global financial crisis of 2008, precious metals initially fell alongside equities as investors sold assets broadly to raise liquidity. Only later, as monetary policy shifted and central banks introduced large-scale stimulus measures, did gold and silver begin their extended recovery. That sequence illustrates an important distinction. In moments of sudden financial stress, many asset classes can move in the same direction temporarily, regardless of their long-term role in portfolios. What also differentiates today's environment from earlier periods is the scale and speed of financial markets. In previous decades, commodities were influenced primarily by industrial demand, mining supply, and long-term investment trends. Today, algorithmic trading systems, exchange-traded products, and global derivatives markets allow large amounts of capital to enter or exit the sector quickly. At the same time, the broader financial system has changed. Global debt levels are significantly higher than they were in the early 2000s, and monetary policy frameworks have evolved following the financial crisis and the pandemic-era stimulus programs. These differences do not determine what will happen next, but they do help explain why historical comparisons should be used carefully. History provides context for how markets behave during periods of volatility. It does not provide a template that markets must follow. Professional risk analysis rarely assumes a single outcome. Markets rarely move in straight lines, and most of the time, several plausible paths exist simultaneously. For that reason, it is more useful to frame potential developments in terms of conditions rather than predictions. Below are 3 possible scenarios based on current observable factors in currency markets, macroeconomic policy, and metals market structure. Frente bull case, continued strength. For precious metals to resume upward momentum, several conditions would likely need to occur at the same time. First, the US dollar would need to stabilize or weaken. Because metals are priced globally in dollars, a softer dollar tends to make commodities more accessible to international buyers. Even a modest shift in currency direction can change short-term demand dynamics. Second, real interest rates would need to remain constrained or decline. Historically, gold and silver have tended to perform better in environments where the return on cash and government bonds does not significantly exceed inflation. When the opportunity cost of holding non-yielding assets falls, metals often attract more investment interest. Third, institutional allocation toward metals would need to remain steady or increase. Over the past decade, exchange-traded products and commodity funds have made it easier for institutional capital to enter the sector. If portfolio managers increase allocations during periods of macroeconomic uncertainty, metals can experience sustained demand. Under this scenario, price volatility could remain elevated, but the broader trend might stabilize or gradually move higher if macroeconomic conditions support continued demand for defensive assets. Base case stabilization. A second possibility is a period of consolidation. If currency markets stabilize and interest rate expectations remain relatively unchanged, precious metals may enter a range-bound environment for some time. This type of behavior is common after strong moves in either direction. In this case, price fluctuations would likely continue, but without a clear directional trend. Traders and investors would focus more heavily on incoming economic data, such as inflation indicators or central bank policy signals, rather than reacting to a single market event. Market positioning would also matter. If speculative positions in futures markets decrease and liquidity conditions normalize, daily price movements may gradually become less extreme than those observed during recent sessions. A consolidation phase often allows markets to absorb previous volatility while participants reassess broader macroeconomic conditions. Out of bear case, structural pressure. The third scenario would involve conditions that place sustained downward pressure on metals. One factor that could contribute to this outcome is continued strength in the US dollar, combined with rising real yields. If government bond yields increase while inflation expectations decline, the relative attractiveness of interest-bearing assets may increase compared with metals. Another potential pressure point would be reduced investment demand. If institutional investors shift allocations toward other asset classes, such as equities or higher-yielding fixed-income instruments, capital flows into metals could weaken. Finally, if broader economic conditions stabilize and risk appetite increases across financial markets, the demand for defensive assets may temporarily decline. Under those circumstances, metals could experience extended consolidation or downward pressure until macroeconomic conditions shift again. These scenarios are not forecasts. They simply outline the conditions that could influence how the market evolves over time. The actual outcome will depend on how currency movements, interest rates, investor positioning, and global economic conditions interact in the months ahead. When markets move quickly, the most useful step is not trying to predict the next price level. It's identifying the indicators that tend to lead the next shift in sentiment. Over the years, a handful of metrics have consistently mattered more than the daily headlines. The first is the US dollar index, DXY. Because precious metals are priced globally in dollars, movements in the currency often ripple directly into metals markets. A sustained rise in the dollar can reduce international purchasing power for commodities, while a weakening dollar typically supports demand. I pay close attention not just to the level of the index, but also to how quickly it moves. Sudden shifts in currency markets tend to create the sharpest reactions in metals. Second, I watch U.S. Treasury yields, particularly real yields after inflation expectations are taken into account. Precious metals do not produce income, so their relative attractiveness often changes when bond yields rise or fall. If real yields increase significantly, capital sometimes rotates toward interest-bearing assets. When real yields decline or stabilize, metals historically become more competitive within diversified portfolios. Third, inflation data still matters, especially the Consumer Price Index, CPI, and the Personal Consumption Expenditures, PCE Index, which the Federal Reserve uses as a primary policy reference. Changes in inflation expectations can influence both currency markets and interest rate policy, and those effects tend to flow through to commodities. Another factor is market positioning and liquidity. I monitor futures market data such as open interest, as well as trading volume in metals-related exchange-traded funds. These indicators can reveal whether recent price moves are being driven by expanding participation or by positions being reduced. Finally, I watch global market correlations. When volatility spreads across equities, bonds, and currencies simultaneously, metals sometimes react as part of a broader liquidity adjustment, rather than because of sector-specific developments. None of these indicators provide certainty, but together they offer a clearer picture of the environment metals are operating in. Short-term price movements can look dramatic, especially when they occur quickly. But markets rarely move in straight lines, and a single trading session rarely defines the longer trend of an asset class. The more productive approach is to stay focused on the underlying drivers: currency movements, interest rates, liquidity conditions, and the broader macroeconomic backdrop. Those forces tend to shape market direction far more than the headlines that appear after a volatile day. For investors and analysts alike, patience and risk management remain essential. Markets reward discipline over time far more often than they reward quick reactions to sudden volatility. And just to be clear, this isn't investment advice. It's simply how I'm reading the market right now, based on the information available and the indicators that have historically mattered most.